When it comes to investing, there are a lot of different types of accounts you can use and invest in, but there are a few of them that give you special tax advantages when you invest in them. And these are typically designed for retirement, so we're going to walk through a couple different options for retirement accounts. First, the one people are most familiar with is a 401k, and this is typically what's offered by your employer, and you can contribute money to it by having funds directly deducted from your paycheck. In 2022, the annual contribution limit is $20,500 if you're under the age of 50, and because the money gets invested before you receive it, that means you're not paying taxes on it. For example, if your salary was $50,000 and you contributed $10,000 to a 401k, your new taxable income would be $40,000. So it's not only a good place to save money and invest, it can also lower your tax bill. And if you work at a nonprofit, at a school, or for the government, you'll most likely have access to a 403b or a 457b, which is essentially the same thing for simplicity, but there are a few minor differences that you'll want to pay attention to if that's what you do use. For self-employed people who don't have any employees, you have the ability to open a solo 401k, which is just about the same as a normal 401k in the sense that it can be used to lower your taxable income. But in 2022, the contribution limit is $61,000, so way more than a normal 401k, or it's 100% of your earned self-employment income, whichever is less. So if you earn $50,000, you just wouldn't be able to contribute $61,000. It's important to note that if you have any full-time employees other than a spouse, you cannot contribute to a solo 401k. Aside from company plans and 401ks, there are a few accounts specifically designed for individuals to save for retirement, and these are called IRAs, or individual retirement arrangements. The two most common IRAs are traditional IRA and Roth IRA, and in 2022 you can contribute up to $6,000 to these accounts if you're under the age of 50. Now, the biggest difference between a traditional IRA and a Roth IRA is when the money is taxed. So with a traditional IRA, if your income is under the thresholds, whatever money you contribute to it is just like a 401k. You can write it off, it reduces your taxable income, and then at retirement, you have to pay taxes on the funds when they're withdrawn. With a Roth IRA, you don't get a tax break in the current year, so you put in money that's already been taxed, you've already received from your paycheck, and then at retirement, you get that money completely tax-free. So you either get a tax break in the current year when you contribute, and that's with a traditional, or you get a tax break when you withdraw, and that's with a Roth IRA. And it's important to note that with a Roth IRA, because the money that you put in has already been taxed, you can kind of treat it as kind of like a secondary emergency fund, because you can withdraw contributions and not have to pay any penalties or taxes. But I mean, it's recommended to leave retirement funds in the retirement account so that they can grow and compound over time. And if you withdraw funds from a 401k or a traditional IRA before retirement, you'll most likely have to pay taxes because you got a tax break when you contributed, so you just kind of have to pay it back. And then you'll most likely owe a 10% penalty as well. And if you're self-employed, you can contribute to either a traditional or a Roth IRA, but there's another one specifically designed for self-employed people called a SEP IRA, which stands for Simplified Employee Pension Plan. Currently in 2022, you're able to contribute up to $61,000, just like the solo 401k, or 25% of your self-employment earnings up to $290,000, whichever is less. In general, with a SEP IRA, you can deduct that year's contributions from your taxable income, and then whenever you withdraw money in retirement, taxes will be owed, just like a 401k and just like the traditional IRA. But one important thing to note is that if you have employees and you set up a SEP IRA, you have to contribute on their behalf, and the amount that you contribute has to be equal to what you contributed for yourself. And the last one we're going to hit on is another type of account for self-employed people, and it's called a simple IRA, which is a savings incentive match plan for employees. It just rolls right off the tongue. In 2022, the annual contribution limit is $14,000, and contributions are tax deductible deductible. A simple IRA is typically easier to set up and manage than a solo 401k, but it has way lower contribution limits. So before deciding which account's right for you, for your business, just need to kind of take your own situation into account and see which one's the best fit. But to recap, some of the different retirement account options are a 401k, a solo 401k, a 403b, a 457b, a traditional IRA, a Roth IRA, a SEP IRA, or a simple IRA.